It's clearly been a difficult year for investors, with the S&P down 15 to 20% and the bond market down a similar amount. This has been caused by the resurgence of inflation to 40-year highs from a combination of energy shocks, excess stimulus, and bottlenecks that have resulted in a monetary tightening cycle from all-time lows. Investors have seen the world economy slow all year and are staring into a recession in the coming 2 quarters, albeit a likely shallow one. So it comes somewhat of a surprise in this tough macro and market environment to see half the European bank shares up this year, not down. Given a lot of the last decade's investment themes have sunk under the new monetary cycle, this anomaly is worth understanding because it is likely to provide an investment opportunity into 23, 24 and beyond. So what is going on? Well, banks are currently posting their highest profits in more than a decade and seeing these profits increase every quarter. What the market has really forgotten is that interest rates rising above negative or zero is hugely positive for most banks. Half their balance sheets that have earned no profits are suddenly becoming a revenue machine. NatWest in the UK saw interest rates rise 6 months before those in continental Europe, and by Q2 of this year, NatWest returns had jumped 50%. We're going to see a similar direction of profit growth for European banks in the coming quarters with the ECB's recent rate increases. The bank sector, though, is currently valued at its lowest price earnings multiple ever. The sector, in fact, would need to double to bring these valuation metrics more in line with long-term averages. Of course, the real question mark is how will the banks cope with the likely recession? Well, we've had the toughest test in COVID, the minus 10% GDP recession, where we saw the bank sector remain very resilient. Interestingly, around a third of the provisions taken weren't used by the banks and are still on the balance sheets and can be used in any coming slowdown and credit cycle. Essentially, buffers have already been built. With the market missing a lot of the interest rate benefits, we are likely to see profits higher in 23 than in the record profits of 22, and we will see profit growth again in 24 and beyond. Financial equities globally are benefiting from the same positive trends. It's not just Europe. What that means is that financial equity might be the one place that investors can benefit from. Financial credit is also likely to see some of their best returns over the next 3 years. AT1s are yielding approximately 10% right now, and spreads are at recessionary levels. With the bond market pricing in sensible terminal rates, we expect a more stable bond market in the coming year, and a reduction in the credit spreads as we go through next year. Depending on investors' risk profile, we see some of the highest prospective returns in both financial equity and credit that we've ever seen.